Tip of the day. Do you know that life insurance have different types of coverages? Term is one of those coverages, has a set time period for coverage. For example, 10 years, 20-year coverage. Whereas primary insurance gives you a lump sum money upon your death. It's given out. But what are the differences? Because inside of the permanent insurance, there are a few different branches, meaning there's whole life, universal life, and variable life in the US. What are they? Well, this is what I'm going to explain to you, which is the best one for you. The best one for you will be if you're using it for temporary purposes, get the term. It's cheap and easy to use, and just have to pay a small amount and it's over with. So you don't have to have any headaches with it. When you're done, and you cancel it. But if you're having it over a long period of time, it's better to get a permanent insurance. You're wondering why? Because permanent insurance covers you for your whole life. Yes, it costs a little more, but it covers you the full length of your life. But if you do it, invest in it properly, you can have free insurance all the way through. So you have free insurance covers the whole life. But what are the differences between those permanent insurances? Well, whole life insurance is the most expensive, but it has a dividend scale for your growth of your money. Yes, so money is paid out in dividend form. So your money never goes down, it's always in the positive. Whereas whole life is that, but universal life is different. It's similar to mutual funds, so it goes into the market, your investment. So you might get better gains than the whole life, or you can have less. Depends on how you want to grow your money. If you want to grow it aggressively, or you want to play it safe. But you have to invest more, invest properly. So if you do it properly, you can get free insurance, one, all the way through. Plus, if you invest it properly and have your money grown, you can have 6 to 7 figure income by the time you retire. And you're wondering how? Think about it this way. If your age is 20 and you have, 45 years before you retire, if you put enough money inside and let the money grow, one, you're going to have free life insurance. Yes, free life insurance. How? If you got enough money of yours, you invest in it properly, and the money that's going inside of it, which is growing on a tax-free basis versus the money on the outside. If your money on your 20th year is equal to what you have inside of it, or more, you got free insurance. Think of this. You invested less money, but your money inside is growing more than what you put in. Isn't that a benefit? What is that? An investment tool. That's what a lot of people use the whole life for, and universal life. To grow the money to invest it. The other benefit for you is creditor protected. So nobody can sue you and take your money. Next thing, it benefits you. You can use the money whenever you like. It's like a bank account for you. You also can use it in retirement, take out the money, and it doesn't affect your CPP or your old age benefit again. It's exactly like a bank account and a mutual fund growing your investments, but on a tax-free basis. The other thing that's beneficial is your mutual funds on the outside. Everybody knows exactly how much you have, what's in there, what all your assets are, but nobody knows how much money you have inside your life insurance. That's for you. It's private. The other is public. So what would you rather have? Everybody knowing how much money you have, or you want to grow your money and nobody knows exactly how much you have, and you can use it anytime you want. But along the period of time, if anything does happen, the protection on it helps out your next generation and your families.